on the non-farm payroll. Doesn't really take out the highs. Does break out a lot of the rejection block, which is the highest up close in the day and in London. So we have that there. And then it breaks down. Then it gets sloppy in here. Lots of run lower, come all the way back. The next candle, we rally up one more time and trade back down. Then we have nice clean delivery of a candle on the downside there. And we run back up here, which is redelivered rebalance. Inside of this range, okay, it works out its noise, if you will. I'm saying that with my tongue in cheek. There's no noise here, but we'll take a look at that in a moment closer. But it drops aggressively, takes out the sell side liquidity there, and then closes right on that same old low. But I'm going to zoom in here and give you a little bit of a explanation of what's going on. Non-farm payroll numbers hits the market here. The algorithm runs up, getting everybody thinking it's going to go higher, so they chase it. Then the market enters a sell program. It breaks lower, and after it takes this big run here to the low, comes all the way back up and snaps back here to a close. The next candle opens, trades higher, and then goes lower. And then the next candle here, we roll all the way down through this low. The lows that I'm concerned with is this one right there, and then the high is this candle here, because we've exited all of this range where we went down, came back up, and started a new pass here, and went lower than that low there. This high and this low, those are your real imbalance points. All of this, and all of this, and in this price action, all of that muddy water gets cleared up if you just go right back to the candle right before all of this mess, and you use the candle's high that took out the low that did all that back and forth price action. So by doing that, anchoring it to the opening price and the low price here, you'll get 139.07 and 4 pipettes. Notice I have this little area down here highlighted. You can go to your forex.com pound dollar chart on the 15-minute time frame, put your cursor or your mouse right on this candle right there. Okay? When you do that, what's going to occur is you're going to see with that candle, notice what the high is up here. See that high? Is that any different than the midpoint here? No. It's perfectly delivered. This is redelivered rebalance. This is one of those signatures that really highlights the fact that these markets are not random. They're not controlled by buying and selling pressure. It's not any of those other things. I'm taking you right to the core of why these markets deliver the way they do. It's not anything other than what I'm telling you it is. Okay? If it were anything other than what I'm telling you, these signatures would not exist in price. And because they exist, and it's so perfect, it begs the question, okay, if that's random price action that takes it right up to here, why would anyone that would not know what I'm teaching you here, why would they know to sell right there at that level when there's nearly nothing over here to warrant that level, to be that precise? And this is exactly what I've taught you in the beginning when I first introduced redelivered rebalance. So when you see things like this, they're hallmarks to controlled delivery and complete manipulation of the currency, which highlights the underlying premise to why you're learning this whole idea of reading price action. Because if the algorithm is referring to these price points, as I'm teaching you here, there's no reason for you to look at other things. There's no other reason to chase harmonic patterns. There's no reason to have any faith in supply and demand. There's no reason to have Elliott wave. There's no reason to have any of those things. Classic support and resistance, forget about it. This takes you to the heart of what the market's doing, and it gives you an X-ray view, even in a high volatile condition like non-farm payroll. Now, obviously, we're an hour after non-farm payroll, so 30 minutes minimum after non-farm payroll. I think if you're going to ever engage, give it at least 30 minutes. That way it works out. The initial run gets the sentiment in play, and usually the public's on the wrong side of the marketplace. And you can see it in here. It delivers exactly how I teach redelivered rebalance. This is the consequent encroachment of that range. Again, the low And then we have this big messy candle. Okay, forget that candle even exists. Just ignore it. And then you have this candle here. Forget that candle even exists as well. Just think of it as from this candle here, we had a range from that low to that candle's opening. There it is. It's done. You've completely got rid of all of this quote-unquote noise. Okay, that noise is the manipulation. We don't look at it as noise. We look at it as manipulation. It gets the market participants confused. Anyone that's seen this short-term high taken out, if they were short, they're probably stopped out and they're not going to try to get back in. Anyone that wants to be a buyer here on the volatility breakout, well, they get in just to get destroyed. So anyone watching on the sidelines, they have no idea what's going on because it's going back and forth for 30 minutes. And then finally, this little run up in here, right to a level I've taught you, precision, not one pipette off, not under, not over, right to the pip. Can't get any better. To the pipette even. That number 4 right there, that's a pipette. That's not even a full pip in price fluctuation. And it's delivered perfectly. And you don't see this taught anywhere else. And anybody else out there just listening to these videos and you're trying to do your little Mickey Mouse mentorships, trying to parrot what I'm saying, even mentioning this to anyone else, you're going to look like you're an idiot, okay? Because you have no idea what we're going to do with it. I'm just introducing it to you here. So it's important for you to go back and look at high volatility market drivers that are coming out in the marketplace, like FOMC, rate announcements, the non-farm payroll, obviously, as we're illustrating it here, and any big news driver that creates a lot of whipsaw initially. If you go back and look at your price data and you see these whipsaw price actions and where it runs down, creates a big wick and trades back up here, then it overlaps that whole run and leaves that range, that candle, use that high, find the one candle low prior to the big, back and forth price action candle, and just erase all of that from your mind. Don't even look at it like it's even there. Forget it. And this is what the algorithm's doing. It's ignoring this candle. It's ignoring this candle because it's already did its work here. The algorithm starts to run higher, not because of buyers. Smart money traders, okay, they're not buying price to send it up to knock out these stops. That's not what's going on. You hear everybody else here that thinks they understand what I'm teaching, and they'll say, yeah, the buyers push price up. That's not what's going on. That's not what's going on. The algorithm is simply expanding and moving higher, offering price higher, 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 no matter how many people are buying. It doesn't matter how many people are buying. Every person that gets basically pushed out of the marketplace, these buy stops, as it goes deeper, 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 deeper above this, it's forcing that liquidity into the marketplace. It's not willing buyers that want to buy because they think it's going to go up. It's not always buyers chasing price because they want to be a buyer. They're squeezing on this high here. The algorithm is doing that. It's only running up to put pressure on this to induce a flood of buyers into the marketplace. So that way smart money can have willing participants. There's liquidity entering the marketplace as a result of that. So it's not buying and selling pressure. It's manipulation and repricing. That's what's going on. But nobody wants to hear it described as I'm teaching it because it gives you the clarity that you really don't have an advantage in this marketplace unless you understand what you're learning here. Once you understand that, it strips away, or at least it will over time, strips away all of the uncertainty and fear about the quote-unquote random market, which doesn't exist. There's no randomness. There are times when you want to be out of the marketplace because the volatility is uncertain. We don't know how far it's going to go up. We don't know how far it's going to go down initially when these high-impact news driver events hit the marketplace, like non-farm payroll. Because the number of passes that could happen on a non-farm payroll event, that's why I'm reluctant to trade on it. Now, I've had in the past where I've traded, and I've shared this on YouTube. I've shared it on Baby Pips. I've shared it in Telegram. I've done it on Twitter. I've traded non-farm payroll. But it's, by far and large, it's not consistent enough for me to feel any desire to be doing it every month. I just don't feel the necessity to do it. But it is important for you to go into it like I'm showing you here and really study it on an intimate level on what it's doing and mark up your charts and fill in these little empty spaces over here and over here with dialogue explaining what you're seeing in price. And you want to write it out and word it as if you knew in advance it was going to do that. And what happens is your subconscious retains that as a false memory. And you're tricking your mind to believe that you had the experience to see this coming beforehand, but you really didn't. But you're studying it and recording it in your chart as if it were just as simple as that. And because you see these things recorded in your subconscious, your brain's letting it in because you're giving yourself positive feedback. And you're basically, again, I've said this in the past, but there's no other way of saying it. You're lying to your subconscious that you were able to see this before it happened. And for someone that is hypercritical, very judgmental, that sounds like foolishness. But this is how you master the psychology side of reading price. You train yourself to believe that you can see these things in your back study and back testing and filling up your journals with examples of pseudo experience. And by doing that, you end up teaching by default your subconscious to see these things because it remembers, oh yeah, I remember the last time I did that and I had a positive response because I recorded it and I have a memory of it. When all you're doing is filling your brain with false memories about something that you didn't really necessarily see beforehand, but you have so many examples of it. When you start seeing the similar characteristics in price action when it's happening live, what's your brain going to refer to? The only thing it has as experience. These good, feel-good moments that you've recorded in your journal. You may not remember every small detail or finite little nuance that's in there, but your subconscious does. And it releases these chemicals in your brain that will override the normal fear and uncertainty that a retail trader has because they're just impulsively going in there and chasing after price. So this is why mentorship is not a one and done. It's not a, here's, let me train with you for a couple of days and we'll call it a workshop and now you're ready to trade with real money. That's not true. You're not taught the right things with these short little span teaching cycles. Like you have to be under the tutelage for a long time to get the benefits of someone, well, in my opinion, to get the benefits from someone like myself with almost 3 decades of experience. So you don't get this from reading a book one time or watching a couple videos on YouTube. You get it from being pressed into these examples and forced to see them as you should see them and studying them in a very specific manner. And by doing that, you'll master psychology and you'll also conquer fear and greed. You won't be tugged by either one over time because the first person you have to beat and master is yourself. And you don't realize how subconsciously you're tricking yourself into thinking that you're never going to be able to do this. You might get one hit wonders here, a little bit over there, or get into something and you think it's going to go somewhere, but then you get scared out of it because you don't want to feel like you've done something wrong and be demoralized over it, even if it's a demo trade or a paper trade. And then when it squeezes you out of it because you just can't hold on to the whole idea of it, then it goes to where you thought it was going to go. And then that hurts, it's pain. So what's actually happening when you're doing those things is you're filling your brain and your subconscious with negative memories and experiences. And then what you end up having is real, tangible memories that you've created by doing these things improperly, practicing them improperly, not submitting to the ideas and saying, okay, it feels uncomfortable. This is a period in time where I'm holding this trade and I feel uncertain about it. You need to log that. But when you're logging it, say, it's normal for me at my experience level to feel a little bit of uncertainty. But I'm sticking to this plan and process, and the rules say I should do this and this and this. That's it. There's nothing emotional outside of that. You acknowledge that you felt that way, so that when you go back and look at your examples and your logs, if you will, in your study journal, you'll remember, oh yeah, I remember having that feeling that you won't necessarily have in the future because you gravitate away from that by doing the right things and recording the positive side of everything and not really leaning so hard on the things that you didn't necessarily see or that you did wrong. So it's important over at least 12 months. You see the whole money cycle over the course of a full year. You see all the volatility injections that come by way of the economic calendar, and you study all of that, and you retain everything as an experience, but you filter it through a positive filter. Not, oh, I'm not never going to do this right. I'm going to fail. I need to make money right now because Michael's starting to have to buy canned goods and everything's going to be running out of the store. And I'm not trying to make light of that, but I can see how some of you are probably, your heads are probably spinning most of the time. There's so many things to be worrying about right now. And that's the reason why I tell you to get prepared, because if you are, you will have all these things to worry about in addition to the normal adversities that come by way of trying to learn this, because it's a very difficult skill set, because it's 90% psychology, 90% of it's psychological. Trading itself is very simple, but doing it and having no fear or greed or natural impulses to put out like little landmines in front of you where you self-destruct and you derail yourself, those things are conquered by entering positivity in your journals and studying them with a perspective that you saw it coming beforehand. And over time, I know some of you that are, again, hypercritical, you'll think to yourself, oh, you're just lying to yourself and you're kicking the can down the road and that's never going to work. Okay, you're entitled to your opinion. But until you actually do it and see how effective it is, your opinion is just that, it's opinion. I did this the same way, and most of my successful students, they're actually able to make money here. They've done this. Okay, that's the secret to it. You got to back test, you got to study, journal, and filter out all the negative stuff. And that's why you don't go on social media. You don't go into that toxic wasteland, Instagram. You don't believe all these people that are lying and stuff, because they have no idea what they're talking about.